Imagine waking up to headlines saying a global financial giant vanished overnight. News channels repeated urgent updates as confusion spread across trading floors. Crowds gathered outside banks hoping to secure whatever savings still remained. This was not fiction, but a harsh financial event unfolding in real time. On a cold Monday morning, confidence across markets suddenly fractured. Employees left towering offices carrying boxes filled with personal memories. A century of legacy disappeared as one of Wall Street's titans collapsed. The fourth largest investment bank announced total bankruptcy, shocking investors worldwide. People everywhere wondered how such a powerful institution could fail. Lehman Brothers had survived wars, recessions, and the Great Depression decades earlier. For years, it represented financial strength, ambition, and relentless pursuit of profit. Leadership began chasing higher returns through increasingly aggressive strategies. They focused heavily on the booming real estate market that seemed unstoppable. Capital poured into their balance sheets like a fast river after heavy rains. Few insiders questioned whether that rapid expansion could last sustainably. Warning signs existed but were buried beneath dense technical documentation. Complex structures made risky positions appear safer than they truly were. Debt was repeatedly used to purchase more debt in an endless cycle. This fragile structure quietly expanded while profits looked impressive. Eventually, the largest bankruptcy in history arrived faster than most expected. Understanding this story helps ordinary people protect their own savings. Financial bubbles begin when prices rise far beyond realistic economic value. Investors start buying simply because they expect someone else will pay more. Greed slowly replaces discipline as excitement spreads through offices and cafes. History shows bubbles have appeared across centuries in many markets. Despite new technology, human behavior during booms follows familiar patterns. At first, only a handful of experienced investors notice unusual opportunities. Soon, the broader public hears stories about easy profits. Media coverage amplifies success stories, making gains seem effortless. Gradually, rational analysis is pushed aside while emotion guides decisions. Banks started issuing large loans to borrowers with weak credit histories. They assumed property prices would continue rising for many years. Investors purchased these risky loans, believing diversification removed most danger. Financial engineers bundled thousands of mortgages into complicated securities. These products spread across pension funds, banks, and insurance portfolios. Rating agencies labeled many instruments as extremely safe investments. That approval created a powerful illusion of security for institutions. The housing market rested on foundations that shifted as payments weakened. Eventually, many homeowners struggled to keep up with obligations. As payments stopped, the chain of financial promises began breaking quickly. Values of mortgage-backed securities started falling faster than expected. Lehman Brothers held enormous positions tied to declining housing assets. They had borrowed heavily to expand those bets during boom years. For every dollar owned, they controlled roughly $30 through borrowing. This practice is called high leverage and magnifies gains and losses. Even small price declines can erase capital when leverage is high. That exact dynamic struck Lehman as asset values slipped. Executives searched urgently for buyers willing to absorb the damage. Potential partners hesitated, fearing hidden losses were larger than reported. Confidence evaporated as negotiations failed and funding sources tightened. Authorities ultimately chose not to provide a direct bailout. That decision sent shockwaves through global finance within hours. Banks grew fearful and stopped lending to each other overnight. The gears of commerce slowed as liquidity dried up across sectors. Stock indices dropped sharply while businesses postponed expansion plans. Millions of workers eventually lost jobs as demand weakened. Retirement accounts saw values fall dramatically within months. Recovery required coordinated actions and many years of rebuilding. Recognizing these patterns early can help individuals prepare. One useful signal is rapidly rising debt across households and corporations. When everyone discusses, quick wealth caution should replace excitement. Watch carefully when asset prices grow much faster than wages. Easy credit often appears before major downturns because borrowing becomes cheap. Low interest rates can encourage excessive speculation across asset classes. A warning sign appears when casual conversations include frequent stock tips. Such enthusiasm often indicates markets are overheating. True investment value depends on consistent cash flow and earnings. Bubbles depend mostly on hope another buyer will pay more later. Pay attention to how quickly borrowing expands compared with growth. If leverage rises faster than productivity, stability may already weaken. Be skeptical of new financial products few participants understand. Complexity is sometimes used to disguise risk that looks alarming simplified. You may hear confident claims that conditions are different this time. History repeatedly shows incentives rarely change as much as narratives suggest. Basic arithmetic and risk still govern markets despite technological progress. Assets that rise too quickly often correct sharply once expectations shift. Maintaining emotional discipline becomes critical when crowds swing between extremes. Diversification remains one of the simplest defenses against concentrated losses. Avoid placing all savings into a single fashionable sector. Holding some cash provides flexibility when valuations become attractive again. Opportunities usually appear when fear dominates headlines and sellers rush. The riskiest entries often occur when confidence feels universally unshakable. Patience allows compounding to work without forcing decisions. Using excessive borrowed money can amplify stress during downturns. Leverage can accelerate gains, yet also eliminate capital quickly. Learning basic balance sheet concepts helps judge institutional strength. The Lehman episode reminded the world no firm is untouchable. Size and reputation cannot guarantee survival when risk management fails. It demonstrated how optimism can blind highly educated professionals. Individuals should research investments rather than follow crowd narratives. Chasing hype can resemble entering a burning building for quick rewards. Look carefully for signs that prices exceed realistic earning potential. If an opportunity appears unbelievably generous, hidden risks are likely present. Protecting capital should remain the first priority before chasing returns. Respecting market cycles helps investors avoid repeating old mistakes. Bubbles will continue forming as long as human psychology drives behavior. Survival depends on staying rational while others become swept away. Knowledge and preparation provide stronger protection than luck. Monitoring debt trends offers early clues about systemic vulnerability. Keeping focus on verifiable data reduces dependence on emotional stories. Another bubble is likely developing quietly in some sector now. Prepared observers often recognize familiar signals before headlines react. During boom, success stories spread faster than cautious voices. Social proof encourages newcomers to join trends without understanding risks. Rising portfolios create confidence that gains will continue indefinitely. This optimism can mask deteriorating fundamentals beneath surface performance. Short-term incentives may encourage risk-taking that looks profitable initially. Over time, accumulated exposure becomes difficult to unwind without losses. Liquidity seems abundant until many participants try exiting together. When selling pressure increases, bid prices can disappear quickly. Markets that felt stable can suddenly behave fragile. Trust between institutions weakens when counterparties question solvency. Funding costs rise as lenders demand compensation for uncertainty. That tightening cycle can accelerate declines across interconnected networks. Globalization means problems in one region spread through shared portfolios. Correlation between investments increases during stress, reducing diversification benefits. Risk models built on calm periods may underestimate extreme scenarios. Human decision makers often ignore warnings after long positive streaks. Career pressure can discourage caution ahead of competitors. Eventually, a trigger event exposes weaknesses quietly accumulating. Once confidence cracks, selling can cascade across leveraged positions. Retail investors may react late, often selling near lowest valuations. Participants who preserve liquidity can acquire quality assets cheaply. This cycle of excess and correction has repeated across many eras. Each generation believes innovation has removed old risks permanently, yet underlying emotions of fear and greed remain consistent. Studying past episodes provides a checklist for evaluating present opportunities. Ask whether revenue growth truly supports current price expectations. Examine how much borrowing finances expansion versus real cash generation. Consider whether demand is organic or driven by speculation. Watch insider behavior, including whether executives reduce personal exposure. Loose lending standards often precede higher default rates later. Rising rates can stress heavily indebted sectors quickly. Transparency in financial statements helps outsiders evaluate true risk. Opaque disclosures often accompany strategies relying on complex structures. Personal responsibility remains crucial when allocating hard-earned savings. Building emergency reserves prevents forced selling during turbulence. Regular rebalancing trims positions that grow disproportionately large. This disciplined approach naturally encourages selling high and buying lower. Avoid constant trading driven by headlines or social media excitement. Focus instead on durable businesses with understandable revenue models. Stable cash generation often helps firms withstand downturns better. Valuation discipline reduces downside if optimistic forecasts fail. Patience allows opportunities to develop without forcing commitments. Preserving flexibility can be more valuable than chasing yield. Historical perspective helps interpret alarming headlines with measured responses. Learning from past crises turns painful history into practical protection. The Lehman collapse remains a vivid reminder of financial fragility. Staying curious and cautious helps investors navigate future cycles with confidence.